Welcome back to the Dividend Diplomats YouTube channel. You're rocking with Bert, the Hurt, Mr. Macho Man himself. And you got Hulk Laney, brother. And today we're talking about a certain pharmacy store that also is insurance in the health industry.
Hulk Laney, everyone, we got to give him some props. He made his Raw appearance last night for the Raw's 30, and he flew all the way over here to record this video. So everyone, let's show Hulk Laney some love here by subscribing to this channel. You know what? Give the video a nice thumbs up. If you recall, everybody, we're trying to get to 20,000 subscribers as possible. In our last video, we threw out a 400 like challenge. We're going to give it until we record our next round of videos, everybody. So we'll probably be recording on Saturday for our Sunday video. You have until Saturday to get Tuesday's video up to 400 likes and enter that giveaway.
Yeah, at the timing of this video, and we're recording this video on Tuesday nights, the video that was released Tuesday morning, we're already at 278 likes. So if you're watching this, go back to that video and let's get to 400.
Yep, the link's above, everybody. You know where to find it. So, all right, Lanny. Let's talk about this because we've been having some discussions offline here. Man, is it hard to find some undervalued dividend stocks right now? The S&P 500 is continuing to have a strong start to 2023. Companies are reporting some better earnings due to inflation potentially peaking, the Fed cooling off some interest rate hikes in the future. Some good news. There's some optimism, everybody. There is some optimism in the market. That's why I'm so pumped up today, Lanny, that you found a potentially undervalued dividend stock that we can actually look at and feel good about buying today.
Undervalued stock. Yes, the S&P 500 is up about 5% year to date through January 24th. Even though today on January 24th, the stock market had a little bit of a technical glitch in the morning that sent share prices either way up or way down. I know UPS took a dump.
I think it was at 165, and before we knew it, you saw the news pop up, glitch, everything's back to normal. Like, well, there goes that.
Yeah. And then I know Apple, Walmart, a few other big companies obviously were a part of that glitch. But you know who's not glitching? The diplomats, guys, because we're here looking for undervalued dividend stocks in this 2023 stock market. Again, consistently finding stocks and buying assets that produce passive income. So today we're talking about CVS, ticker symbol, Bert's favorite, CVS. Yes, and Bert had mentioned before this call, showed up the news with Amazon. I believe Amazon is really Hogan leg dropping the prescription medication space right now.
Yeah, I don't know if it's so much the Hogan leg drop. It might be like the Shane O'Mac at the top of the Hell in the Cell, where he's just giving it like the prayer up. Like, is he going to land on the table? Is he going to hit the person? Is he not? We don't know. Amazon's been rumoring how they're going to enter into this sector for the long
coast to coast.
Yeah. Yeah. So what's Amazon doing? $5 subscription for Prime members. It's going to get you access to a handful of generic prescriptions. I think we looked it up before this. It was like 60 maybe. And I'm sure over time that will expand. They're dipping their toes in. They're going to see what happens. So the natural question is, how is CVS, how are Walgreens, how are the two of those companies going to respond to Amazon finally doing something substantial?
It's the salt and the SWAT, guys. Amazon versus CVS. I feel like we've heard this tape before. I want to say it was about 5 or 6 years ago where the big threat of Amazon entering the prescription medication space was coming knocking on the door.
Well, you're right. And that's why I'm saying it's like him jumping off the Hell in the Cell. You don't know how this is going to end up. This could be a disaster for Amazon. He could land it, but it could be a disaster. And that's why we still need to take a look at CVS now and see if news like that, along with some of the other headwinds that companies are facing in this environment, are making CVS a screaming buy. And Lanny, how do we evaluate companies?
Guys, we look at the dividend diplomat stocks. We're going to focus on 3 metrics. 1, the price to earnings ratio less than the S&P 500. 2, that dividend payout ratio less than 60%, preferably between 40 and 60%, really speaking to the safety of that dividend as well as the future increases to that dividend payout. We look at that dividend growth. We want to own a stock that continues to grow that passive income stream your way. And then as a cherry on top, we'll look at the dividend yield. And as Bert indicated, because of this Amazon news, as well as other items, CVS is actually down year to date in 2023 through the first 3.5 weeks, down about 7.5%. They're down about 16.5% dating back to last year, Bert.
So let's see. Let's start running them through. Remember, stock prices as of January 24th, 2023. That first metric, everyone, that price to earnings ratio. Let's talk about it. Closing price, $86.02. Forward EPS is $8.86. That gives you a PE ratio of 9.71x here. Huge discount compared to the market. So you first metric number one, nice little check mark for CVS.
Well, let me tell you something, Jack. Now, CVS also, we'll go through some of their earnings and balance sheet as well. We'll probably do that at the end just so we can round out really how they're performing and how they're shaping up for 2023. But we'll dive into that second dividend payout metric, or that dividend diplomat stock metric, that dividend payout ratio. And guys, this thing is so low right now based on future earnings of 2023. 27.31%. So you're taking that 60.5 cent per share per quarter, or $2.42 per year, taking that over $8.86. So you're at only 27% on the payout ratio.
Let's put a pin in this though, because we're going to come back to the payout ratio and why it may be that low. So hang tight with us, everybody. Metric number three. So what we usually do when we look at the dividend growth rate, we'll look at that 5-year average dividend growth rate historically, and we'll look at how long companies increase its dividend. But there has to be a modification here for CVS, because CVS for a period of time stopped growing their dividend. So we're going to look at their 2-year average dividend growth rate. Why did they stop increasing that dividend? They made a small, tiny, itty bitty acquisition back in the day. They acquired Aetna in 2018 for a balmy $69 billion. So immediately after the acquisition, management was like, whoa, 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 hey, take it easy here on the dividend growth. We're going to maintain the dividend, pay down the debt, keep our focus on fixing the balance sheet from the acquisition, which is a prudent move. We got to respect it. So they paused the dividend. But Lanny, what happened? Is it back?
Guys, they've been resuming their dividend. I think almost not to say thanks to COVID, but COVID allowed better cash flow, because they were distributing the vaccines. So they were getting a piece of the pie there. So they were able to pay down their debt much faster than what they were anticipating back during the acquisition of Aetna. And guys, they've resumed it. It's now been blasting at 10% the last 2 years, from 50 to 55, and from 55 to 60.5 cents per share per quarter. So CVS is playing the Eric Bischoff music. I'm back.
And I'm better than ever.
So guys, huge company here, again, projected over 300 billion in revenue. So it's no wonder that they wanted to get back to dividend growth.
Yep. And so let's look at that. Let's round this out here with the yield. Their yield is 2.81%. So very solid dividend yield above the S&P 500. So you're getting a little bit of premium on the yield front to hold them compared to an index fund.
So guys, this company is 113 billion market cap. Again, we'll show the metrics on the screen again, but to talk a little bit about CVS right now, the balance sheet actually, I really want to focus on as we're in a rising interest rate environment still. Again, Fed will have a nice 25 basis point increase come the 1st of February. They actually have less than a 1 times current ratio right now.
Oh, all right. So, all right, Lanny, let's talk about this for a second.
I guess the one positive spin is that they've almost doubled their cash and cash equivalents from year end of 2021 to 9/30. And it has improved the current ratio from about 0.88 to 0.94, so up 6 basis points, almost at that 1-to-1, again, current assets to current liabilities. And it's kind of the same direction that you see with the quick ratio. Obviously, there's more inventory, being held right now still at all retail, so you got to think retail. But 0.69, I usually like to see at least above a 0.5, so they do fit that bill. But I would want them to be a little bit closer than 1 than further from it.
Yeah, so let's check out the other part of this too with the debt, because we talked about how they wanted to pay down the debt. That's why they paused the dividend. The debt is decreasing over the last 9 months. It dropped down from 51.9 billion to 50.8 billion. So, hey, they're making some progress. They're chipping away at it. So it's good.
Yeah.
It's what you want to see. Things are moving in the direction that you want to for their long-term debt.
Anytime you can hack off 2% of your long-term debt in less than a year is it's definitely solid. They made significant progress in 2020 and 2021. So you have to love the trend of their long-term debt. It's not net going up, it's net going down. So you definitely have to like that. So go ahead, Bert.
I was gonna say, let's summarize it. Let's flash up and then I can run through them, Lanny, and then let's hear your perspective on CVS and what you may or may not be doing. Price to earnings ratio 9.71, payout 27%, 2-year dividend growth rate 10%. Now that they're paying dividends again, so they're back for 2+ years, the yield of 2.81%. What are you thinking here, Lanny? Tell us your thoughts.
At 86, I think I wanted them like to be below 85, but the part of me, I'm like, well, that balance sheet, I didn't really think that they were going to be they're definitely still liquid. They have plenty of cash and equivalents, but you really want, a better balance sheet. It's improving. That's key. I'm sure management has that in their long-term strategy. So I feel like 85 now might be a little bit too soft, maybe like $83 a share. And I think I'm going to start nibbling at around $83 a share.
Yeah. And you can always keep nibbling on the way down too. If you really want to pick up CVS, you're just looking for something. It's not quite 83. Just grab one. It's lower than it's today. Just keep going on the way down. There are many ways you can do it, but I'm also in the camp. You know your price. You stick to your price. And just keep investing. I mean, I think that's really what it is. It's not CVS. You have your regular index investing, which I know you've talked about here and you wrote about on the blog. There's plenty of options out there. So stick to your metrics, stick to what you want. It's your portfolio. Do what you like.
It's my portfolio and I want it now.
All right. So what do you think about CVS? You've heard Lanny's take on this. Are you running to buy CVS right now? You sticking for $83 a share too? Do you want to see a yield above 3%? Let us know. And everybody remember, there's still time to enter that competition before Saturday. Get that video from Tuesday to 400 likes so you can enter the Diplomats giveaway.
And that's the bottom line because Bert said so. So guys, appreciate the feedback. Don't forget to subscribe. Definitely give this video a nice thumbs up. You're either with us or you're against us, brother. That was Bert the Hurt and Lanny from the Dividend Diplomats. Over and out.